All right, good morning. Today is Thursday, April 17th, 2025. Raise your hand if you're ready, if you're happy that tax day is behind us this year. We are definitely happy that tax day is behind us this year. So welcome. This is our monthly capital markets update and outlook presentation for the month of April for the second quarter 2025. Appreciate all of you taking some time out of your busy schedule to be here with us. I got a few technology challenges here for us today, so bear with me here just a second. All right, wonderful. All right, so if a lot of friendly faces in the room, I think I've met everybody in the room, know everybody in the room, so wonderful. If you are, I do see some people joining us online, so if you are new here, if you're joining us for the first time, my name is Eric Hagen. I am a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, of our Chief Investment Officer, Tom Fox, who we will be hearing from in just a couple of minutes, financial advisors Dan Oshman and Rana Grant, and then our client support team, Karen Miller. Karen just joined us on Monday, so if you have a second to give her a very warm welcome, we would love that. Introduce yourself, say hi to her afterwards, and we're just super excited that she is here with us. And then, of course, John Knutson and Marilyn Westmark. Together, our goal is to help individuals, couples, and families make their next financial decision, and then the one after that, a good one. One of the ways that we deliver on that commitment is through today's monthly update. Today is an opportunity for all of you to kind of look over our shoulder, get a sense for how we view things out there in the stock market and the economy. And really what we're talking about, what we're thinking about is coming in the short term and even in the longer term. We want everybody to be a more informed investor. So again, today we're going to hear from Tom Fox. Tom is going to review the positives in the markets. He's going to go over the headwinds. There's a few more headwinds this month than there was last month. So we're going to go over the headwinds, and then he's going to give us his outlook of what he thinks it means for the future. So again, ultimately, this is your opportunity to look over our shoulder. We love your questions. There will be time for Q&A, so if you have any questions whatsoever, we'd love to field those at the end of Tom's message. If you are watching online, whether you are with us here live today or in the recording, you can email me, you can text me, you can drop a question in the comments section. I do get those, and I will bring them to Tom at the end of today's message. So please do not hesitate. Any question whatsoever, we would love to field those questions. Tom spends all of his time more behind the scenes doing due diligence, market research, really focusing his attention on the economy and the markets. He's coming up on 40 years experience building investment strategies. As you can see on the screen, he has a very impressive and long resume. I'm, as always, very excited to have him here with us today. So with that, I will bring our theme for 2025 up onto the screen. I'll bring Tom onto the stage. Tom, can you hear me?
I can hear you. Can you hear me?
Yes, we can. Welcome.
Okay.
Thank you. An extra thank you today for being with us. We know you're a little bit under the weather.
Yeah, I ended up flying back on Monday through the airports and so on, visiting my grandson. It was his birthday, and I think I caught something because I ended up with a fever last night. And I'm feeling pretty good today, but my wife goes, "You're not going to go contaminate them all." So I decided to listen to her, so you guys don't get what I have. And but I'm feeling pretty good today. But thank you for being there. Sorry I wasn't there physically, but I'm there virtually.
Appreciate you.
And the times they are changing, that is now is becoming a very appropriate theme for 25. It was our 24, but now this year things are really changing, and we're probably in very unprecedented times, which makes it very difficult to analyze and forecast with the rapidness of change and what's going on in the overall economy and the tariffs. And we'll look more at that and give you our view of where things are going to go. So we'll get into our outlook, and we always like starting with the bad things or the wall of worries, and there's certainly plenty of them, uncertainties, and of course what we now have is a growth scare that started about over a month ago, and then all of a sudden, which I forecasted that we would start to hear a recession talk again, and that certainly has emerged. So the growth appears that the economy is slowing. However, we just saw retail sales and they were better than expected. So it hasn't really hit yet, but that does not mean it won't hit as we move along in the months going forward. But there's certainly a lot of concern out there that there's going to be a broader slowdown and maybe even a recession, but we'll see how that all shakes out. Another problem with the market right now is the amount of volatility. And on top of that, the investor sentiment. We've seen volatility spike, go down. We hit 60 on the VIX, which is an indicator of volatility in the stock market. And you don't hit 60. We saw that last at the great financial disaster that took place in 2008, but also when the pandemic broke out. So we've seen volatility similar to those periods. And typically when that happens, it becomes an opportunity. We're going to talk more about that as we go forward. And obviously the trade war escalation, tariff volatility, it seems to change. I wrote on here 145%, but overnight, President Trump raised Chinese imports to 245%. So this is a moving target. It wasn't on everything, it was on a few items, but still there's a trade war. It's emerging. It's trying to get China to come to the table. We'll see, because that culture is very different than our culture. They want to save face, so we'll see if he's successful in that. We've got the consumer sentiment decline. The University of Michigan survey dropped to levels we haven't seen except for during economic crisis. So the consumer is very worried. Inflation expectations have risen. Now that's kind of by political party. If you break out the inflation expectation in the consumer sentiment surveys, it's pretty much Republican saying lower inflation and Democrats saying higher inflation. So it really is a party-driven index. So I don't put a lot of weight on it, but it is saying that things are very volatile out there. Also, 35% of consumers expect their income not to increase. That should be not increase. I think it says increase, Eric, but they don't expect it. Only 35% expect it to increase, and so that's a very low number. That's not very bullish on the market or their future. So it could mean that the consumer, which is 70% of the GDP or gross domestic product, will potentially start to slow down. And so we're going to keep an eye on that. But that's some of the risk out there. And then you've got earnings risk. I brought this up. I've been saying this for a while, that I thought the 2025 earnings forecasts were too high. They were expecting double digit in the 15% earnings growth rate. And of course, that's all coming down right now. Downgrades are accelerating. They're lowering earnings expectation because of the uncertainty that is out there. And of course, we got geopolitical risks. You got tensions with China. You've got Russia and Ukraine. You've got Middle East. So you have a lot of different things going on there. And then, of course, the market correction and volatility that we talked about above can cause the consumer to pull back. And that's what we're concerned about, is that the consumer will pull back as we go through the upcoming months. Now, we always have reasons to own stocks. And so it's important that, we want to look at each side. the worries, and then also why we should own. And one is that selective tariff implementation has offered relief. And you saw not that long ago that the market went up 9% in the S&P and over 12% in the NASDAQ in one day. If things in the tariff world start to get resolved, you could see a massive rally in the stock market. That's what we'll talk more about, why you need to be invested, because it can happen, and it can happen very fast. And there's potential for trade negotiations with China. We're not there yet, but I think China will have to come to the table eventually. Because they're right now, they had a great first quarter GDP in China, but that was because they were preempting the tariffs. But now this next quarter and the next after are going to be very difficult unless there's some sort of resolution in that. And there's a shift among the administrations going to be shifting towards pro-growth, lower taxes, infrastructure spending, and stimulus, maybe a stimulus for the economy. So Trump is very pro-business. So that's a very positive for the stock market. And also the historical resilience after market sell-offs. When you get a big sell-off, that creates opportunity. So, and we'll look at some data, but historically, when you get a big sell-off, especially when you have high volatility, that's a good time to enter the stock market. And of course, there's the Federal Reserve readiness to support markets. Although Powell came out, I think yesterday or the day before, and he said he's going to be on hold, and President Trump had some comments regarding that. He's a little late on everything, and he wants to replace them, but we'll see. But they do have the ability to lower rates, even to buy more treasuries. So they've got room to support markets. It's called the Fed put. Although after hearing Powell the other day, it doesn't seem like it's on the table, that Fed put, but we'll see. It could be employment driven, or it could be inflation continues to come down. And the other thing, we had spectacular inflation numbers. They came in lower, much lower than expected. So we're certainly not seeing in the data yet any inflationary issues going on. And then, of course, attractive valuation. When you get a market pullback, there's certain areas or sectors in the market that become very attractive because you can come in at a lower price. And we see that in the growth area, especially technology, where it has become very attractive because of the sell-off. Much of the growth or technology are in a deep correction, and some of them are even in a bear market, which is 20+%. So there's opportunity to come into these companies that have high growth, but now you're getting it at a very reasonable price. Then you have the long-term growth of AI and technology, and that's not going to change. It's the future. And so these tech stocks are most likely going to do very well. They'll have strong revenues, strong earnings as we go forward, because this area is transforming everything in our country and around the world. So I thought this picture would be a good one. Trump tariffs, and of course that's the stock market. That's the impact that he's had on the stock market. I found that online, so I thought you would like that. But that's him, and he's the one behind this. Now, tariff anxiety is high. You can see it's higher than it's been since 2015. And this is what's going on in the markets, why it's so volatile, is that the trade tariffs, we don't know where they're going. Is it transitory? Is it going to be only just temporary, or is it going to be more sustained? So we'll have to all see how that all works out. But there's certainly a lot of anxiety out there because of tariffs. Now, what's the overarching goal of the Trump administration? Well, it's reduce the trade deficit. And you can see but in this graph, this is the deficit. In other words, we're importing that much more than we are exporting to that country. And you can see across the board, there's tremendous deficit here. And this is what President Trump's after, what his administration's after, is to equalize that. And if you go and sell, if you're an American company and you go to sell in China or other areas in the world, you're paying tariffs, while we weren't charging anybody tariffs here. So it's an unfair balance, and this is why President Trump is trying to fix this, but it's going to be a little pain in between. Now here's our reciprocal tariffs. This is what the United States has put on these countries, because that's what they charge us. Some of them, they even charge more. Now, in China, I had it 54%. Then I raised it to 145. Well, last night we went to 245. So you can see that what's happening is he's trying to equalize the trade. And so it becomes a fair economic board to work on. And we'll see how that shakes out. But this is the reason all this is going on. Now, will the market rebound? That's the big question. Well, if you look at the volatility, it touched 60. The last time I mentioned this, the last time it touched 60 was during COVID and the great financial crisis of 2008. These were historic market impact events. So what has happened here is the tariffs. I don't see the tariffs at the same level as the COVID or great financial crisis. But either way, it went to 60. But that can be good news when you get that kind of volatility. We'll see that on the next chart. So if you look at the next chart, you'll see when volatility became extreme. Those are the red dots going across. And then, of course, it takes what happened to the stock market 6 months out and 12 months out. And you can see the returns were very high, 12% on average for the 6 months out after extreme volatility events, and 20% after extreme volatility events 12 months out. So this is attractive, because historically this has been a good time to enter the stock market. Now, we remember on April 4th and 5th, we had two gigantic down days in the S&P 500. It was down 4.8%, and the next day it was down 6%. Now, that's only happened 4 times before. We've had that extreme downside and at that velocity and speed. But what's happened, if you look after, there's a bounce typically after that. But if you look 12 months out, it's 33% average or median, 34% average return going forward. So when you get that extreme volatility to the downside, that can be good news for patient long-term investors. Now, this is another chart which shows valuation. And what it is, it's relative not to the recent highs of valuation that we were experiencing last year, but this is the 10-year average. And what it shows is that the NASDAQ is at a big 11% discount to the 10-year average. What does that mean? Well, the upside of a down market is you can buy stocks, especially technology stocks, because primarily NASDAQ is overweighted to technology. You can see that all of them are now below their 10-year average, which means that the stock market is not expensive, especially in the tech area. Now, you remember when President Trump, and we had that big upswing, 9% in the S&P, 12 in the NASDAQ, when he put a 90-day tariff pause. Goldman Sachs on April 9th had put a 65% probability of a recession. That's pretty high. The day after April 14th, after Trump said he would pause 90 days, they've now gone down. They've lowered that, and they're down below about 48%. So what you can see is how fast this can move. And, a Goldman Sachs is a well-known firm, great research firm, but you can see they had to adjust in just a few days their recession call and bring it back into probably a lower probability of recession just by one change in the market. Another view of this on the next chart, you can see that the recession was up to 68%. This is Poly market. It's the Betty market odds. This is where people put their money down on where they think it's going to go. And you can see that it was up as high as 68%, dropped to 44%. Now it's at 48%, similar to Goldman Sachs. So what this is a moving target, but you can see that right now, currently, recession odds have fallen below 50%, which should be good for the economy and stock market going forward. Now, the next few charts are important for you to think about, because nobody likes volatility. Nobody likes uncertainty. There's so many things going on in the world today that can make you very anxious, but winners stay invested even during uncertainty. If you look at this chart, it shows, well, should I be out of the stock market, out of the bond market, and just be in cash? Well, if you look at this, cash is not always king, because this says to stay invested. This is a 60-40, 60% stocks, 40% bonds. But you can see how often it outperforms cash being in that ratio. And it's over 60% is the lowest, even on a monthly basis. So 1 year, 3-year hold, 5-year, you can see how high it goes. But it just shows you don't want to be out of the market and just go to money market funds, for example. You want to stay in. It's a losing game to stay in money market funds. Now, what happens during crisis, during high volatility times, if you missed a few of the days, upside days, and you can see that if you stayed fully invested, the first left bar there, you would have gained 10.9%. If you missed just 10 of the best days during high volatile periods of uncertainty, you're only at 8.1. If you missed the 20 best days, you're only at 6.2%. So I don't know about you, but I'd rather be in the 10.9%. And you can see it goes all the way down to 1.8 if you miss 50 of the best days. So it's very difficult to time the market or to try to determine when to come in and when out. Because for example, if you miss that day that he put a pause on the tariffs, well, that market moved 9 and 12%. So you could miss that kind of a day in one moment. So what we encourage investors to do is not panic, stay the course, because it will work out. All right, I'm going to show there is some economic and earnings showing some weakness. We'll look at that. Here's the economic surprise index that's put out by Citi. And what it shows is that there's more economic data coming out on the weaker side than on the stronger side. So there is a trend right now. Historically, we're not at the dangerous areas, but what it does show is that the economy is starting to show some decline in its growth rate. Now, this one's kind of hard to see, but what it shows is this is the consensus. If you look at the blue line, it's not the straight blue line, that's sort of the direction of it. But if you look at it, the consensus for earnings has been dropping. And if you look at the red arrow, you can see those green bars to the right are going up, which means there's more companies that are starting to revise downward the earnings. So there is a trend towards more and more companies are downgrading their earnings outlook, and analysts are downgrading their earnings outlook. And of course, earnings ultimately drive stock prices. So this is something that we have to keep an eye on. We forecasted this earlier on in the year that this would start to take place. All right, other red lights. Well, we're watching. Now this was very short-lived, but this is when the world questions U.S. Treasuries and the U.S. dollar as the reserve place to go invest and to own the United States dollar. You can see that the yields on the 30-year spiked tremendously while the U.S. dollar value went down. So that hasn't happened like that. Typically, they're pretty closely aligned, but you can see that there was a disruption there. I have a friend who's a bond trader, institutional bond trader, and he said a lot of the 30-year spike in yields came through an unwind of a number of hedge funds that had huge leverage positions, and they had to unwind the treasuries. So that's probably partly of why this spikes so much. But you can see what kind of impact the tariffs are having and so on the U.S. markets. This is a sort of an interesting one. We haven't seen this since 20, which was the pandemic. But you can see this is investment grade bonds exodus, fourth largest in history, where people started fleeing investment grade bonds. These are corporate bonds that are supposedly with strong companies. This is a little concerning. We're going to keep an eye on this one, but that usually the credit markets are a pretty good signal of what's to come. So this is something we're watching, but it's an unusual exodus of investment grade bonds. How many we mentioned this earlier, but how many consumers expect real income gains? It's the lowest since 9/11. So that just shows you that people's sentiment towards their jobs, their income, the outlook of the economy is starting to fade. Here's another sign that the consumer may be pulling back. This is data from the top 10 U.S. airport, shows that there's weakness and it's gone negative in arrivals. You can see it's starting to roll over, and it's even negative around 5%. So there's been a decline in U.S. traffic at the major airports. So that's a good sign. We heard Delta and others sort of warn that the consumer is starting to pull back a little bit. However, the next chart shows that this could be mainly the Europeans. You can see the number of Europeans traveling to the U.S. has cratered. So a lot of that, maybe that number is influenced by Europeans not coming to the U.S. We'll have to see. But you can see that in every country over there, they quit coming here, or they're certainly the number of people coming over is declining. So that could be one of the reasons that the airports are not as full as they used to be. Housing market. You can see that rates have gone over 7%. This is the housing market has been struggling with high interest rates. This is one of the reasons why Trump wants Powell to lower rates, is because the housing market needs a boost. And it's obviously going the wrong way. It's heading back to its old highs. We'll see where it ends up, but this is not good for the housing market. And that's people that were in low mortgages aren't moving because they have low mortgages, 3% or 2.8 or maybe even 3.5. So why would they go into a 7+% mortgage rate? So this has certainly put a big damper on the housing market. So what's our outlook? This is our original outlook, and I checked. You saw this last month, but I checked the areas that we got right, and there's quite a few of them that we got right. But now I have a new one. This is a little different. I'm expecting the economy will slow, and tariff-induced recession is still possible. Still, we don't think it's going to happen, but the odds or the probabilities are increasing. We expect very high stock market volatility, but a lot of that volatility may be to the upside if some of these negotiations that are taking place right now begin to happen. You could see a huge move to the upside. There's good and bad volatility. You got bad volatility when the market's going down, but you got good volatility when the market's going up. So I expect there will be some huge spikes in the stock market over this next several months as things resolve. Technology stock restart. As you know, technology stocks have been beat up quite a bit, but I believe they're going to regain the leadership. And as we approach and head towards the end of the year, I believe tech stocks will recover. I think they have the most upside right now. They have the revenues, they have the earnings, and so on. Then we have, I believe inflation will rise, but I think it's going to be temporary. Our inflation numbers were very low in this last reading, but we'll see what happens as we go forward. I do believe there'll be a spike, but then I think it rolls over as we approach the end of the year. I also think that there's going to be unemployment. It's going to rise, and I think it's going to approach 5%. I think companies are going to start laying off because of the uncertainty, unless things get resolved quickly. And so we're going to probably see a higher unemployment rate. And I think that as a result, the Fed will have to lower rates. You call that the Fed put. They're going to have to counter the unemployment rate that I expect to rise. And we haven't changed really our outlook for the year. We expect stocks to recover by year end, achieving a 1 to 10% return. And of course, we always have the wild card events that could shock the stock market. But that's our new and updated outlook.
Awesome. Thank you very much, Tom, for not feeling well. You did a great job, so appreciate you very much. With that,
I'm glad I made it through it.
We are too. With that, I will open up to any questions. So let's start with everybody in the room. Any questions whatsoever that we can bring to Tom? Well, Tom, if you cannot hear, if you can't hear Jim, let me know, okay?
I cannot hear him, no.
I'm kind of quiet. Anyway, with all this, obviously we all know what Trump is trying to do. You think it's the right thing, or I believe something had to be done to counteract all of this imbalance in exports, imports. But is it the right thing, or if it wasn't this, what would it be?
Well, I think it is the right thing, but when you haven't changed anything since 1933, it's a difficult change. And I think the one thing that I think perhaps he could have done a little differently is approach it not all at once, but little by little. But he decided to go for the whole thing. And I think that's why the markets have been so unstable, is because he's trying to accomplish it in one swoop. He's only got 4 years. And of course, you got midterms coming up. So I think one of the reasons he wanted to get this done and put to bed, before the midterms come. And I think it should be done. I just think it could have been done probably at a slower pace.
Well, my comment about should have done it at the slower pace. It's obvious Trump got the attention of China and all the rest of the countries. Doing it piecemeal may not have accomplished that. So
It
I'm
may
sure.
not have. You're right. The shock and all is probably more effective to get deals. But when he put the pause on for 90 days, there are many countries now coming to get that done. They probably need a lot of lawyers in Washington, D.C. to get that done. But yeah, I think you're probably right. Even though the markets didn't like it, it brings instability and uncertainty. But I think it's probably necessary. Or I think this will be in the history books as one of the greatest things I think that any president has ever done.
How's that for an answer?
Yeah, it's great.
But we got to get through the next 6 to 12 months.
Got another question here for you from Les. Tom.
Is there any indication that the taking money out of the stock market to put into the crypto market, and does that have an effect, or would that have any effect?
The way I look at the crypto market, especially Bitcoin, which is the main one, that it's a source of liquidity. And when the market goes down, now I've seen some low correlation recently, but typically you want to be in crypto or other alternative asset that when the stock market goes down, it goes up or holds steady to offset the direction of the stock market. However, crypto over the long term, Bitcoin, has actually gone down with the stock market, and even a lot more than the stock market. So I look at Bitcoin as if things really go bad, I think it will be a source of liquidity to cover other areas like the stock market or shorting or margins or a need of money. I think the first place that people go will be crypto, and which means it's got more downside than the stock market. I don't know if that answers your question. I'm not too much of a Bitcoin guy.
It answers it.
It answers it. Thank you, Tom.
Yeah, so you've seen more downside than the stock market. You've seen, and I think it's a source of liquidity. So if things go bad, they're going to just take the money out of the Bitcoin. I don't see it as a hedge at all. I'd be interested in it if it was a hedge, but it hasn't proven so far to be a hedge.
I think we've got a follow-up question on the crypto topic.
So President Trump and his administration talked about doing some reserve of the government's monies into the crypto or currency and so forth. Has that been paused a little bit while all this volatility is happening? Do we know, or is that still something that they're investing in?
I think that hasn't been done, and yeah, that's a ways off. But it certainly brought a rally in the Bitcoin when that first was announced. Now it's come down since then. I think it's in 80 some thousand. Let me look where we're at today.
They're holding.
I don't know if that's going to help. I think it did initially, but that's old news now. And it's going to take a long time before that actually is accomplished, and whether it can be done is still a bigger question.
Herman, did you have a question?
Yeah.
I've got another one here for you, Tom.
Yeah, relative to the tariffs, as the tariffs accumulate, will it have a significant effect on how significant will the effect that it has on the national debt?
Well, it should help the national debt because we're bringing money in. Trump wanted to lower taxes and increase tariffs. And so the idea was that the importers into the United States, the companies selling to the United States, would pay most of the tariff, and because otherwise the consumer won't buy it. So I think it's going to be very positive going forward. And of course, I think he'll probably keep 10% tariffs on for a long time, but it is helping bring down. You got Doge, and you've got operating and functioning to lower all the corruption, waste, and spending. And then you have tariffs coming in. That's all going to be positive for a lower deficit. We'll see how much it impacts. We got to quit spending so much, though.
On tariffs.
Another one on tariffs.
So Tom, we obviously as consumers we've not felt we've felt some pain, but not a lot of pain yet from these tariffs. I mean, it's going to be a delayed reaction. Do you forecast that that's a 6 month, 12 month before we are really going to feel the pinch for manufacturers and prices and things like that? Where do you see that happening? Is that a 2026?
I think it comes sooner. I think it could come sooner
Okay.
than that. But I think it could be transitory. In other words, prices could go up initially faster than we expect, but whether or not those prices are going to stay high, I don't think so. I think they'll be coming down in 12 months. I expect the inflation rate, that's what I forecasted, would go up, but I think I think by the year end or even into next year, it's going to go the other way and head towards the Fed's 2% goal.
Okay, so folks that might be looking at like major purchases, like a house or something, and you've got some cash position and you've got some areas that are you recommending that maybe would be wise to not do those types of things until you kind of find out what's happening with the tariff changes and prices of goods and things like that? Materials.
Well, the housing market's already in a bear market. It's already struggling because of the high interest rates. So, location. Are you paying cash for the house? Are you mortgaging the house? All those make a big difference.
Okay, thank you.
Tom, this whole process of has been over a long period of time where we don't make anything in this country anymore. It's all been shifted to China, Mexico, wherever. Do you see in the years ahead where that will reverse, that we'll start manufacturing and back here in the United States instead of overseas?
Oh, definitely. Already companies are starting to build out manufacturing plants. It takes time, though. Apple's going to invest $500 billion here. You've got a lot of companies that are going to invest in the United States to avoid any tariffs in the future. It's definitely going to bring back manufacturing, but it doesn't happen overnight because the construction and the build out of these factories are going to take some time. I think also that robotics is going to play a big part in these new factories as that begins to emerge even more and more than it already has. I think robotics are going to be, in other words, we're going to have state-of-the-art manufacturing here. But Trump, this is Trump's plan, is to bring manufacturing back here, and it will happen.
Great, thank you.
Taiwan Semiconductors, they're building a plant. There's a lot of things going on right now, and there's a lot of foreign companies that want to build a plant here so they can enter the market without tariffs. So there's going to be a lot of manufacturing coming back to the U.S., which is long overdue.
Yeah. Good. Thanks, Tom.
Great, thank you. Yeah.
That's going to be such a benefit long term for the U.S. worker.
Cool. Any other questions in the room? I just checked online and I don't see any right now. So if you're online and have any questions, this is kind of your final opportunity. We've got one more in the room here, Tom.
Is AI going to have any huge effect in the next few years in the market?
Can you repeat that, Eric?
Yeah, is AI going to have any large impacts, large effects in the next few years in the short term?
Oh, yes. Yep. I use it right now. And yeah, more and more companies are using it, and it's just going to get more powerful. The ability of AI is increasing. I don't know if you have Chat GBT, but you can get that, and it's amazing what that thing will put out for you. Just about anything. And so companies are using it for efficiency, looking for ways to that a human can't figure out, where they can take a very large company, complex company, and resolve a lot of issues because of AI. So AI is going to be dominant theme. This is a transformation. This is like the internet, in my opinion.
We have barely scratched the surface on understanding what we can use AI for.
Yes.
We've,
And it's only going to get bigger and bigger.
Yeah.
And it's a huge deal. This is, again, like the internet. When the internet first came out, it was only being used by a few people, universities. Now look at it. Everybody's on the internet. So AI is very similar. That's why we like the AI companies today. We think they were overpriced before, but they came down in price. Now we think they're very attractive. And plus, as opposed to, let's say, the technology move we had in 2000, where we had only technology stocks outperforming everything for like 3-4 years, their earnings and revenues weren't there like they are today. These companies are profitable. They have tremendous balance sheets. They have tremendous growth prospects. So this is a little different than when the technology crash. Remember, I don't know if you remember that, when the technology stocks went down 60, 70, 80%. That's not going to happen with the AI companies, because it's the future.
A lot of heads nodding, Tom.
So, and we have ownership in our portfolios. We've got a lot of investment in that area, because we expect that to be, outperformers going forward.
Excellent.
BlackRock,
Any other questions
the
in the room
largest
here?
investment firm, agrees with that.
Say that again, Tom.
BlackRock, and they're tilted towards AI because they think it's a game changer, and they're investing.
Yeah. Excellent. Any other questions in the room here? Great questions today, you guys. We love your questions. All right. Take one more glance online. If you're online and have a question, and get it to Tom for you. I don't see any here. All right. Well, this afternoon, the recording to this presentation will be available on the website, along with a summary that some of you guys in the room have already. If you want a summary, or if you'd like to ask a question, so if you think of another question after you leave here today, or if you're online and think of a question, maybe you're watching the recording, want to keep it private, you can use that button on the website to go ahead and do that. Mark your calendar. Our next monthly updates, we do these updates every single month, update the content, same structure, the positives, the headwinds, and what Tom thinks it means moving forward. So next one is scheduled right now for Thursday, May 15th. Again, that's 11 a.m. Central Time. We will be online only, not partially online like we are with Tom today, but we will be online only for that presentation. Quick reminder, I start off my week every Monday morning, 9 a.m. with a much shorter update on what's going on in the markets, 9 a.m. Central, 3, 5, sometimes 7 minutes long, things that are happening around the office, take a quick look at what happened in the week prior and some of the things that we're watching. So if you're not and want to join me, would love to have you. 2 o'clock Central Time, I sent out an email linking back to that with any other additional color, commentary, things like that we have for you. And again, all of that is on our website. So with that, take one more glance here. I don't see any other questions. So Tom, you fought through it. You did fantastic. Thank you so much. We really appreciate you. I will go ahead and close this off. Do you have any final words?
Stay the course. And the volatility will be coming and going. But the one you want to be concerned about is missing out on the upside volatility. Because if any of this starts getting resolved, you're going to see the stock market go up very fast.
Yeah, we already saw evidence of that, so I think you're exactly right. All right, well, with that, that concludes our monthly update for April 2025. Thank you guys all for being here. Really appreciate you. Thank you to those of you online. I can't see who you are, but I do see that you're out there. So thank you for being here, and we'll look for you again next month. Bye, everybody.
Thank you.